Hi everyone, welcome to JAIIB Boosters. In this session or in this video, we are going to discuss our third paper of JAIIB, that is Accounting and Financial Management for Bankers. In this module A, that is unit 6, that is nothing but depreciation. In this whole video, we will going to know what is depreciation, what are the methods of depreciation, and how by using those methods how we will solve the problems regarding to depreciation. This is we are going to discuss in this chapter. Let's move on to the first point. Depreciation. What is the depreciation and to which depreciation will apply? Fixed. Fixed assets are the assets which are used in business for more than one accounting year. In this case, depreciation is used for fixed assets. It doesn't used for current assets or capital assets, whatever the other assets they are, but here depreciation will be used for fixed assets. What are the fixed assets? Fixed assets are the assets which are used in business for more than one accounting year. To calculate depreciation, if we have purchased in mobile, okay, if we have purchased a new mobile, if we have to know how much it has been depreciated, the value of that mobile after 1 year. If you purchased the mobile for 35,000 and if it has so many scratches, then the value of the mobile will be decreased, right? So the value will be 20 or 10,000 as the mobile has been used for 1 year. But in the same way, if I have purchased another mobile but I haven't used this mobile, but after 1 year the value of that mobile definitely will decrease, right? So fixed assets are the assets which are used in business for more than one accounting year, which we are using for more than one accounting year are called as fixed assets. Okay, let's know what is depreciation. Is nothing but declining in the value of a fixed assets. Means, let's take an example of phone, right? After 1 year, though, then it is called fixed asset. So the value it will decline, I mean the value it will reduce, right? So the decline in the value of assets, how it will reduce due to usage or passage of time. Here, here usage has been done, but in this case there is no usage of time, but there is a passage of time. It has been over 1 year. So in this case, the value of the assets will decline, which we can say it as a depreciation. Next, if a business enterprise procures a machine and used it in production process, then the value of machine declines with its usage, right? If a businessman purchased a machine, then after after a period of time, the machine will be used in the production purposes. So the value of the machine will reduce. Even if the machine is not used in production process, we cannot expect it to realize the same sales price due to passage of time or arrival of a new model. Because here we have already seen the examples of phone. So in the same way, even the machine is not used, but the value of the machine will be reduced because it has been due to the passage of time. Here the time has been over. I mean the time has been passed. It implies that fixed assets are subject to decline in value, and this decline is technically referred to as a depreciation. The the declining in value is nothing but a depreciation. This is about depreciation. Let's move on to the next one. Depreciation is a part of operating cost, okay, and is a non-cash expense, right? Here, depreciation will follow matching concept. Depreciation will follow matching concept. Requires that the revenue of a given period is matched against the expenses for the same period. Okay. What are the causes of depreciation? Wear and tear due to actual use. This is the main cause of depreciation, wear and tear. Effects of time. Passage of time will cause a fall in the value of an asset even if it is not used, because if it is not used, there is a passage of time. So then depreciation will occur. Next case is obsolescence. A new invention or a permanent change in demand may render an asset useless. If I have purchased a mobile, let's take an old version. If I have purchased a mobile it's keypad. If I have purchased a mobile of keypad phone, but after some time of inventions of many models, we all change it to Android mobiles, right? So the value of these assets also has been reduced. That is nothing but obsolescence. Fall in market price. These are the causes of depreciation. Move on to the next one. What is the need for depreciation? To know the correct profit. To know the if we are buying something, we have to know what we are getting from that product and how it will be helpful for our assets. Okay. To know the correct profit, to show the current financial position, and also to make provision for replacement of assets. This is the need for depreciation. Next. Here we are going to discuss accumulated depreciation. Previously we have discussed what is depreciation, right? Now we are going to discuss accumulated depreciation. What is a depreciation which accumulated depreciation is nothing but depreciation which gets accumulated year by year. Okay, when depreciation charge is not deducted from assets and it is recorded in separate account, that is called provision for depreciation account. If the asset, let's take the same example, phone. If we purchase the phone for 50,000, after 1 year the phone value may reduce and it may get for 35,000. But there is a depreciation of 15,000. But we are not deducting these 15,000 from our assets, because if we sell the same phone which we have purchased for 50,000, we will get only 35,000 for that. Here we are not going to deducting that amount from our assets. That is, depreciation charge is not deducted from assets, and these 15,000 is recorded in separate account. That is called provision for depreciation account. Okay. Asset account appears in its book at its original value. The original value of this mobile is 50,000. At the time of sale of assets, accumulated depreciation from this account is transferred to asset account. It will be transferred to the asset account. Next, accumulated depreciation is neither an asset nor a liability. Okay. In this case, the depreciation account, we will convert the depreciation account to the provision for depreciation account. In this case, depreciation account will be the debit, and the provision for depreciation account will get credit. It is not transferred to profit and loss account, but depreciation is transferred to profit and loss account. Here, accumulated depreciation, okay, accumulated depreciation will transferred to profit and loss account, but depreciation, sorry, it is not transferred to profit and loss account. Accumulated depreciation is not going to transfer to profit and loss account, but depreciation will be transferred to profit and loss account. This is very important, keep in mind. Next, when separate provision for when separate provision for depreciation means, as we are moving something through without deducting it from assets and we are moving that to our separate account, that is, account is not maintained, the provision account, and account is not maintained, the provision account is not used, the depreciation directly changed to how it going to change, the depreciation account to the asset account, it going to change. Okay. When separate account provision for depreciation, that is, here the separate account provision for depreciation account is not maintaining. Okay. Here it is maintaining, then the depreciation charge to be if separate separate account will it maintain, then the depreciation will be like this. How? Depreciation account debited to provision for depreciation account. If it is not maintained, then it would be the depreciation account to asset account. Okay, let's move on. What are the methods of depreciation? Fixed percentage on original cost or straight line method. Okay, reducing installment method or return on value method. Sum of digits method. These are the three methods we are going to calculate for depreciation, and we are going to discuss these three topics with examples, I mean to say with problems, how we are going to solve this. Okay, next, what is straight line method? We have to know what is straight line method. Okay, this method is based on assumption of equal usage of the asset over its entire useful life. It means the if it is for 5 years, then from first year to second year, 2 to 3, 3 to 4, 4 to 5. Here the usage should be the equal. So there is an equal usage. Okay, this is the earliest and the one of the widely used method of providing depreciation. What is the formula for depreciation? Cost price of asset minus scrap value. Cost price of an asset minus scrap value by estimated life of the year. That is nothing but years. Okay, next. According to this method, a fixed and an equal amount is charged as depreciation in every accounting period during the lifetime of an asset. This will going to be understood in the question. Okay, this method is known as fixed percentage on original cost method. Every year, same amount is charged as depreciation in profit and loss account. As we have seen that depreciation is going to transfer to PL and profit and loss account, but the accumulated depreciation is not going to transfer the PL and account. This makes comparison of profits for different years easy. Okay, what are the features of straight line method? What we have to know, what is the formula for that? Cost price minus scrap value by estimated years. So here we need the cost of an assets must be there, and also salvage value. Scrap value is also known as salvage value. Life of the assets. These are the things we have to find. We have to know while solving the straight line method. Next. Okay. Purchase of second-hand car is 86,000 and spent 30,000 for repair. Estimated life is 5 years and the estimated residual value or scrap value or salvage value, whatever it is 56,000. Calculated by SLM method is nothing but straight line method, the first method of depreciation, which is a very old method and very useful method. Okay, let's move on to the question first. Here, what is the total cost here? Total cost of here as car is another asset. Okay, what is the value here? 86,000 and we spent 30,000 for its repair, that is plus 30,000, so the total is 1,16,000. This is the total cost of our assets. And also here there is an next, what is the lifetime here? The estimated life is 5 years. So what is the formula for SLM? That is cost of an asset minus scrap value or salvage value, that is scrap value scrap value cost of an asset minus scrap value by estimated life. So what is the cost of assets here? 1,16,000 minus what is the scrap value in the question, that is 56,000, by what is the estimated life here? It is 5 years. 50,000 by 5. That is 10,000. 10,000 is our depreciation per year. Okay. Depreciation per year is 10,000. If we need the percentage here, we have to calculate depreciation percentage. That is how we are going to calculate depreciation percentage. What is the depreciation per year here? 10,000 by what is the total cost of an asset here? That is 1,16,000 into 100. Calculate this one and you will get the depreciation percentage here. What is that? 10,000 divided by 1,16,000. That is 8.62%. This is the depreciation percentage. Okay. To find out the depreciation percentage, in the numerator it should be the depreciation per year and in the denominator it should be the total cost. Then we will get the depreciation percentage. Next. Here the scrap value of machinery at original cost of 1 lakh. So here the cost is 1 lakh and the estimated 1 lakh is estimated at 10,000. In this case, here they have mentioned scrap value of machinery with original cost of 1 lakh is estimated at 10,000. So here the original cost is 1 lakh and the scrap value is 10,000. Okay. So here depreciation value after salvage, that is 1 lakh minus 10,000, that is 90,000. And what is the formula for depreciation? In SLM, that is, what is the total cost here? Assets 1 lakh minus scrap value is 10,000. By what is the estimated life, useful life here? That is 6 years. That is 90,000 by 6. So that is 15,000. Okay. What is depreciation in? Here they are asking depreciated value at the end of 4 years. This is the value of per year. This is the depreciation value per year. They are asking at end of 4 years. So we have to calculate depreciation in 4 years. That is 15,000 into 4. That is 60,000. And they are asking at the end of, if they ask a depreciation in 4 years, then we will calculate the depreciation per year into number of years. But in the question, they are asking depreciation value at end of 4th year. So that is, what is the original value of the asset? 1 lakh. What is the depreciation in 4 years? That is 60,000. Every year 15,000. So after 4 years, that is 60,000 has been decreased. I mean depreciated the value of the original asset. So 1 lakh minus 60,000, that is 40,000. This is the value of the assets which we have purchased for 1 lakh. This is the depreciation value at the end of 4th year, that is 40,000. If you have any query, you can comment on this channel. Next. This is the second method of depreciation, that is written down method of depreciation, WDV. What is WDV? Under this method, depreciation is charged on book value of the assets. They may give in the question which of the following is incorrect. They may give this question not only in the problematic and also they give in this question as theoretical. In which cases we will use this written down value method, that is book value of the assets. Since book value keeps on reducing by the annual charge of depreciation, it is also known as reducing balance method. The another name for written down value method is reducing balance method. The amount of depreciation goes on reducing year after year. So the value will reduce not if every year they have the same value, then we will use the SLM method. But in this case, there is a reducing year after year. So it is known as reducing installment or diminishing value method. The amount of depreciation reduces year after year. What are the features of the written down value? Cost of the assets must be there and fixed percentage rate of depreciation is needed and also the life on asset of assets. These are the things we have to know while solving the written down value method. Next. Here is the question. Here is the question of WDV method, that is machinery purchased for 4 lakh. Annual appreciation is 20%. Calculate WDV at end of third year and final year, fourth year. Okay, let's calculate the question. Now first we have to calculate for first year because it will reduce year by year. Okay. What is the asset value here? Asset value is 4 lakh. What is the depreciation rate here? Depreciation rate. What is the depreciation rate here? 20%. So what is the depreciation here? The asset value. The asset value is 4 lakh. Depreciation is 20%. So the asset will be reduced by 20%. So the answer is here 80,000. So this is the depreciation value. So what should be the new asset value? It means what the value of the asset after 1 year, in the sense at the end of the 1 year, that is the actual value is 4 lakh, but after the depreciation, here the depreciation rate is 20%, so 20% of 4 lakh will get reduced, that is 80,000. So the final asset value at the end of first year is 3 lakh 20,000. So after the first year, this going to be the value of an asset in WDV method, because we are going to calculate year after year. Only after the final value only we will use for it. So at the end of second year, we are going to calculate second year. Same case. Here the asset value will be previous new asset value, that is 3 lakh 20,000. So the depreciation is 3 lakh 20,000 into 20%, that is 64,000. So here the new asset value is equals to 3 lakh 20,000 minus 64,000, that is 2 lakh 56,000 is the asset value at the end of second year. At the end of second year. So now we are going to calculate at the end of third year, which we have to find in the question. To find out the third year, we need an asset value. So the asset value will come from the second year. So we have calculated it. For the asset value of the second year, we have to know the first year value. So we are going to calculate step by step. Here the asset value is 2 lakh 56,000 and the depreciation rate is 20%. So the depreciation value is 2 lakh 56,000 into 20%, that is 51,200. Sorry. So here the new asset value is 2 lakh 56,000 minus 51,200, that is 2 lakh 4,800. This is the depreciation value at the end of third year. Next, the final one of this question is fourth year. At the end of fourth year, here the asset value is 2 lakh 4,800 and the depreciation rate is 20%. So the depreciation value will be 2 lakh 4,800 into 20%. That is the depreciation value in the fourth year is 40,960. So the final asset value, new asset value, the final asset value of this machinery at the end of fourth year is 2 lakh 4,800 and minus 40,960. That is, the value is 1,63,840. Okay, this is the value of this machinery at the end. This is at the end of fourth year by using written down value method. If they asked you at the end of the first year, then this is going to be the answer. If they asked at the end of second year, this is going to be the answer. And then at the end of third year, at the end of third year, the answer is 2,04,800. Next, here some of the years digit method. This is the last method of the depreciation. That is one method for calculating accelerated depreciation. Sum of the life of compared to the straight line depreciation method, the sum of years digit method will result in higher depreciation and a greater tax benefit. Okay, how we will calculate for here? Here, the estimated useful life of an asset is for 4 years it's going to be 4 plus 3 plus 2 plus 1 10. But for 5 years it's going to be 5 plus 4 plus 3 plus 2 plus 1, that is 15. And also for 6 years it's going to be 6 plus 5 plus 4 plus 3 plus 2 plus 1, that is 21. For 7 years it's going to be 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1, that is 28. This is how we will calculate sum of years digit. And here, how we are going to calculate the depreciation here? That is original value minus salvage value into remaining year, remaining useful life by sum of years digit, sum of years digit. What is the formula here? Original value minus salvage value into remaining useful life by sum of years digit. This is the formula for sum of years digit. If you solve one or two questions, you will understand how to solve this question. So let's see the question. Here, this question, an equipment cost of 1 lakh with salvage value 25,000 and useful life for 5 years. Calculate depreciation for second year, third year, fourth year, and the fifth year. Here, we are going to calculate this on the method of sum of years visit method. Okay. In this, what is the formula of what is the formula for depreciation under sum of year visit method? That is original cost minus salvage value into remaining useful life by sum of years visit. Okay. This is the formula of depreciation under sum of years visit. Here, what is the cost of an asset? That is 1 lakh. Okay, let's move on to the question. For first year, what is the first year? That is, what is the original value here? It's 1 lakh minus, what is the salvage value here? 25,000 into, for the first year, Formula is remaining useful life. For the first year, initially, the lifetime of the asset is 5 years. So for the first year, there is a till 5 years of useful life. That is 5. And the sum of years digit for 5 years. That is, if for 1 year, it would be 1. For 2 years, it would be 2 plus 1. For 3 years, it would be the 3 plus 2 plus 1. For 4 years, it would be 4 plus 3 plus 2 plus 1. In the 5 years, it would be 5 plus 4 plus 3 plus 2 plus 1. That is going to be 15 years. On sum of years digit, if the useful life of 5 years, then it would be the 15. That is equals to 75,000 into 1 by 3. That is 25,000 depreciation value on by using sum of years digit method. And also here, this is going to be the depreciation value. Okay, depreciation value. And also we will calculate the depreciation rate for the same year. How it going to be calculated? For the first year, remaining useful life will be 5. Here it is the sum of years, this is 15. That is 5 by 15. 1 by 3 is equals to 33.33%. This is going to be the depreciation rate. Okay. For the second year, same. But here the remaining useful life will change. That is, the original cost is 1 lakh minus 25,000 into remaining useful life will be 4 years, right? Is equals to 75,000 into 4 by 15. That is 20,000. Okay, the depreciation value is 20,000 and the depreciation rate would be 4 by 15. That is 26.66%. Okay, next, third year. Same, 1 lakh. 1 lakh is the original cost, 25,000 is the salvage value into 3 by 15. That is equals to 15,000 and the depreciation rate would be 3 by 15. That is 20%. Next, fourth year. That is 1 lakh minus 25,000 of salvage value into 2 by 15. That is equals to 10,000. The depreciation rate would be 2 by 15. That is equals to 13.33%. Next, fifth year. That is 1 lakh minus 25,000 into, in the fifth year, the remaining useful life would be final 1 year is equals to 5,000. So 1 by 15 is equals to 6.66%. If they given for the 6 years, then it would be the sum of years digit 6 plus 5 plus 4 plus 3 plus 2 plus 1. That it would be 21 years. Okay. So, hope everyone understood how to calculate sum of year digits by the years. So that it will be, they asked to calculate for the second year. Second year is 20,000 and the depreciation rate is 26.6%. And also the depreciation value for the third year is 15,000 and the depreciation rate is 20%. The fourth year, for the fourth year it is 10,000 and the depreciation rate is 13.33%. And for the fifth year it is 5,000 and also the depreciation rate is 6.66%. This is how we are going to calculate sum of years digits. By using this method, we will calculate depreciation in this way. Let's move on to the next question. Let's see the question. Here, an asset has a life of 5 years and the depreciation percentage age in second year. They are asking in second year, means on the basis of sum of years digit method. For the 5 years, the sum of years digit method will be, for 5 years, it will be 5 plus 4 plus 3 plus 2 plus 1. That is 15 years. 15 years. Here they are asking in the second year. So, in 5 years, first year has been finished. So, the remaining useful life will be 5 minus 1, 4 years. So, it would be 4 by 15 because remaining useful life by sum of years digit, that is 4 years, and the sum of year digit of 5 years is 15 years into 100. So 4 by 15 into 100, the answer here is 26.67%. For this question, the depreciation percentage age is 26.6% is the depreciation range in the second year. For 5 years life of an asset by using this of sum of year digits. You definitely see the question regarding these problems and or any theoretical question also in this chapter. Next. That's it for this session. Hope everyone understood the Unit 6 of Module A, that is depreciation topic of AFM. If you have any query, you can message us on our Telegram channel, that is JAIIB Boosters, and also you can comment on our YouTube channel. If you really feel this session is useful, then like, share and subscribe our YouTube channel. That's it for this session. Thank you.